Each fee, Harper said, was to be paid in silver dollar coins convertible at the legal and lawful ratio prescribed by the law of Federal Reserve notes to silver dollars. Well, hello there, my friends. Rafi here from the End Game Investor with this week's silver report for Arcadia Economics. And I have the sexiest silver story I have ever read. Whoever this woman is, I want to meet her. She needs to be interviewed. She needs to be celebrated. She needs to be lauded. She needs to be at the center of the silver community, because it's stories like this and silver that restores my faith in humanity. This video is sponsored by Fortuna Silver Mines, one of the more financially responsible mid-tier silver miners, also a gold miner out there, in my opinion. They have net debt of just $50 million with a market cap of over $1 billion, and it is one that I personally own. Let's get to that story first, and then we'll get into what happened with silver this week and what may happen in the weeks ahead. This story is from the Iowa Capital Dispatch, and it will make you smile. AntiVaxxer demands $17 million in silver from boss, then wins jobless benefits. All right, it wasn't a complete victory, but you're going to love this story. An Iowa hospital employee fired after refusing a COVID-19 and demanding her employer pay her $17.2 million in silver dollar coins, in part for its face mask requirement, has been awarded unemployment benefits. State records indicate Lori D. Harper worked as a systems analyst for Mercy Medical Center from July 2015 until she was fired in October 2021. A month before her termination, Mercy's president and chief executive officer had sent an email to all employees informing them they were required to be fully until against by November 15th. Now, this is the awesome part. On September 19th, Harper sent her employer a series of documents via certified mail. In those records, Harper informed Mercy she would conditionally accept the hospital's offer to be injected with the if the employer would first provide proof that the would be entirely retrievable from and also removable in its entirety from my body, person, and womanhood after each shift that she worked. Failure to do so, Harper stated in the documents, would be deemed an admission of personal liability for damages resulting from her termination. Harper didn't respond to several subsequent requests to meet with management and was eventually suspended due to unprofessional, insubordinate, and unacceptable conduct. Management then reiterated a request to meet with Harper and reminded her she could either be or apply for a medical or religious exemption. In response, Harper drafted a notice of liability regarding trespass and fee schedule and paid a process server to serve those documents on Mercy's president and chief executive officer. The fee schedule imposed a $10 million fee for Mercy for unlawful termination, a $2 million fee for every trespass in my private matters, a $2 million fee for DNA copyright infringement, and a $500,000 fee for unlawful request to wear a face covering at work. Each fee, Harper said, was to be paid in silver dollar coins convertible at the legal and lawful ratio prescribed by the law of Federal Reserve notes to silver dollars. As husband of a wife who was also terminated for similar reasons and refused to meet with them for disciplinary reasons, I really want our wives to meet. But anyway, with that beautiful, wonderful story, let's go into what's happening in silver this week. Take a look at the First Majestic Silver Store. This is where I personally go to get much of my bullion. Everything is sold out. Why? Because the price is too low. And what is happening with premiums? Check this out. This is Silver Eagle premiums. I'm showing you this because we are at a new post-2008 record. 40.38% premium for Silver Eagles. These are elevated because the U.S. government is in charge of minting them and they are incompetent and trying to squeeze the supply for some reason I don't understand. But the more important premium, I believe, is the 90% junk silver premiums, which just jumped from about 17.3% to 18.09% premium, A new post-silver squeeze record. Silver squeeze was over here, February 2021, and it's been going up ever since, and we just passed the December 2021 peak of at 18%. We are at 18.09. Now, the reason why this is so important is the following. This is a long-term chart of junk silver, physical premiums, going back to 2008. Notice what is happening over here, where my little magnifying glass with the plus on it, which doesn't really do much, is circling 2011, 2012, basically the period between 2010 and 2013. Physical premiums at certain points in 2011 and 2012 fell below zero, which means functionally that the price of physical silver was below the spot price. Now, what does that tell you about the spot price? It was too high. It was too elevated. It hit $50. It was a little bit too early. And there was very little demand for physical silver back then. It was all a speculative game of traders and short squeezes. That, the key is not what is happening now. What is happening now is very different. The price is rising again. You can see on this chart over here, we have an elevated price, especially since 2019. And we are still in this range that looks about to be broken out of, but premiums this time are elevated. Yes, there are spikes here, but these spikes in premiums generally happen when silver collapses, as it did in 2020. And so the price of physical stays stable as physical demand stays stable when silver collapsed on the COMEX. Here in 2016 at the low, there was also elevated premiums, and here during the silver crash of 2013. So those are understandable. But now when the price is elevated and physical premiums are going up anyway, that means the demand is in the physical markets rather than in the speculative markets. Obviously, there is demand in the speculative markets, but it is being matched in the real world at this time, and that is what is key to understand. In other news, we've heard the media talk about consumer price inflation peaking. That is not going to happen, save for maybe some select categories, but definitely not for basic necessities like food. This is a chart of the number of ships waiting outside the port of Shanghai, which is China's biggest export city. We are literally off the charts here at about 470 ships. Get ready for a supply chain breakdown. They've been supply chain strains up to now. This is a full breakdown. Here is a visual of what is going on off the port of Shanghai. Look at all those ships just waiting to pick up their goods that they can't because Shanghai is under some crazy lockdown that this time the Western world doesn't seem to be following. So at least we're getting over that level of insanity. But expect consumer prices to keep rising. That is the point. As for the technicals, there was a bit of a sell-off over the last 2 days. It is not a big deal. We did not even touch the 50-day moving average. We tested it. That is all that is happening. There is room to test the 200. Do I think it's going to happen? No, but if it does, it shouldn't be a big deal. And keep in mind that in gold, we haven't even touched the 50-day moving average. We haven't even tested it. It's down at 1931. So the metals look good from here, and we can have a panic buying day or days at any time. So be ready, be calm, and keep stacking. It is also critical to realize what is happening in the 30-year fixed mortgage rates, not for the reasons that you think. I'll explain. The 30-year fixed mortgage rate is now above 5%, and I believe 5.2, 5.3, something like that. We hit a new high post 2018. This is when the 10-year Treasury rates hit a high of 3.24. 30-year mortgage rates are already above their highs from 2018. And the point of this is not necessarily to say that housing prices will fall, and they probably will. The question is what happens to silver when that happens? And the answer is it will rise for this reason. This is the amount of mortgage-backed securities on the Fed's balance sheet, and it is still rising. It rose by about $25 billion since last week. They are still buying more. They are still printing money to do this. Now, what happens to mortgage-backed securities when the price of housing falls and people cannot pay their mortgages? The price of mortgage-backed securities, as we know from 2008, falls hard. And since these are the assets backing the dollar, because they exist on the Fed's balance sheet, when these assets fall on the Fed's balance sheet falls into something called negative equity. And that is what causes the dollar's purchasing power to fall. It is also happening to Treasuries. It is happening to mortgage-backed securities. It is happening to all the paper that is behind the dollar, because by virtue of it being on the Fed's balance sheet, and that is the liability sheet of the US dollar. Sorry, that is the asset sheet behind the US dollar, which is the unit of liability. The Fed does have some amount of gold on its balance sheet. Let's not debate whether it's actually physical there, and assume that it is, though it might not be. When this paper that is on the Fed's balance sheet falls in value, what happens is the value of the gold on its balance sheet must rise to compensate that loss of value. And from there, as the gold to silver ratio rises and the public understands that the dollar is losing purchasing power and they run to silver, the gold to silver ratio falls and silver rockets. Now, what about the value of Treasuries on its balance sheet? Well, two things. Here is what the Fed said. One of these so-called hawks on the Fed board, St. Louis President James Bullard, on Monday said a 75 basis point move should not be ruled out if needed, although it wasn't his base case. U.S. central bankers say, and this is really hilarious, they can slow price increases without causing a downturn, but that goal may be more difficult if supply chain disruptions caused by the pandemic persist. Let's examine that claim, shall we? How many times was the Fed successful in slowing price increases by rising interest rates without causing a downturn? Well, let's go back to the 1950s and see. We have here conveniently shaded in all the recessions since 1954. And here we have the federal funds rate. When they go on a rate hiking cycle, what happens? When do we get recessions? Exactly when they start hiking. Here's one, 1957. Here's two, 1960, after another Fed rate hiking cycle. Here is three, 1969. Interest rates were pushed up to 9%, another recession in 1970, 1971. And again, another rate hiking cycle, 1973, another recession, and they cut rates. So they've failed 1, 2, 3, 4 times, 5 times, 6 times, 7 times, 1989, 1990, another recession. 8 times they failed, another recession. 9 times they failed, 2007, 2008, recession. And finally, we come to this last rate hiking cycle, 2.38%, July 2019, repocalypse. Repo rates hit 10%, another recession. So what do you think is going to happen now after 1, 2, 3, 4, 5, 6, 7, 8, 9 failures? 10 failures. Are we going to have an 11th one? Yes. But this time it is going to be hyperinflationary when the Fed does a final pivot and does one last round of money printing, and you better have your stacks ready before then, because their great reset is going to fail spectacularly and blow up in their faces. Their plans for central bank digital currencies and domination of the monetary world, and by extension the world itself, is 100% going to fail. Why am I so sure about this? Because awesome people like Lori Harper in Iowa demanding $17 million in silver coins still exist on this planet. And in their merit, this game is going to end, and we are going to win. I wish everyone a great week. Stay focused. We're getting close. This is Rafi of the Endgame Investor with this week's Silver Report for Arcadia Economics, and I'll see you next week.